So I'll tell you guys about syndications in general, but here's what I see in the market shift right now. You guys might be feeling that it's a little difficult to get deals done right now because 60% of people have residential mortgage loans at or under 4% interest rate. And so even just conceptually, if you want to buy something, it makes it difficult for you to want to sell a house if you have a 4% to buy something at 6 or 7. And that's on the residential space. So until interest rates come down far enough to make it seem okay, it's only maybe 0.5% or 1% of a jump, we can kind of afford this, it makes sense. It's going to be a while before the residential space really opens up. Now, on commercial loans, things are a little bit different. So in the commercial world, typically loans have balloon payments after 5 years. A lot of people got into value add with these bridge loans when values were going up quite a bit in 2020 and 21. And that basically is loans that are 75, 80, 85% loan to value or even loan to cost. And they have adjustable interest rates, and they typically have a 3-year balloon. You can usually get 1 or 2 extensions beyond that for another 1 or 2 years. But basically all these loans, if you got a loan in 2019, 20, 21, 22, it's coming due, this year, next year, the year after. And this Wall Street article basically said a lot of these lenders don't want to foreclose on these owners right now. And so they're extending the debt for, into this year, 2024, which basically means there's, $900 billion of loans that's coming due. So a lot of these apartment complexes either need to get paid off, get sold, or get refinanced, and values in multifamily are down. So if they're going to refinance, they have to bring money to the table in order to refinance. So usually it makes sense to just sell it. Okay, so we do multifamily syndications. So basically what that means is we pool a bunch of people's money together to buy these deals. So we look at a lot of deals. I probably underwrite 100 different deals, and we'll make offers on maybe a quarter to half of those. But out of those, we only buy 1 deal for every 100 that we look at. There's a lot of just bad deals out there, people that want higher than we think it's worth. So when we find a deal, our job is to go and get it. We'll put it under contract, we'll put the earnest money up, we'll pay the attorneys to write up the legal documents, we'll pay for inspections, appraisals, all of that. We put our capital on the table, and then we say, who wants to be a part of this deal? We'll send out an email to all of our investor database. We say we're buying a $5 million building. We need to raise $1 million of equity. We'll get usually 75, 80% loan to value. So we'll get a $4 million mortgage, and we need some people to come in. So we do deals usually between 1 million, probably up to our biggest, we've been 8.5 million so far. But then individuals can come in and say, I want to put in 50,000, 100, 200, whatever the amount is, and then you are that percent owner of the deal. So typically how these work, we usually do these on a 5-year pro forma. And the reason being is because we all know that the market changes so much. So if we tell you we're going to sell this in 2 or 3 years and the market tanks again, we don't want to be locked into having to sell. We want to wait until it's the best time to sell for everyone. So we usually say, expect to hold on to these things for 5 years, maybe 6 or 7 if we really need to. But our job is to make the most amount of money for everybody as possible. So the first year, we're going to buy something, and we're going to spend the full 12 months renovating it. So these are bigger apartment complexes. Usually they're 20, 30, 40, 50 units. So every month we have people moving out, and we're going to renovate 2, 3, 4 units at a time. Once they're renovated, new people move in at the higher rent, and then the next month people move out of different apartments. We renovate those. So it's kind of a churning cycle. It takes us about all of 12 months to get all of the exterior and interior renovated. The second year, we're finishing up anybody that we didn't renovate, or anybody that we had problems with, or whatever the problems are, and then we get it stabilized. So we'll take rents. If we're paying $900 a month when we buy it, we're going to try to get it to at least $1,200, $1,300 a month, and make sure that everybody's paying that, and we have hopefully between 3 to 8% vacancy on the property, and everything else is cash flowing pretty well. So from there, we'll cash flow it years 3, 4, or 5 until we sell it. But if the market's in a good spot, year 2 or year 3, we might just sell it and maximize returns for everybody then. So one of the other benefits that people do these syndication deals is because we can do cost segregations. So how many people know what a cost segregation is? Okay, a couple people. So basically, whenever you buy a property, either a house or a commercial building, you get to take a paper write-off from the IRS called depreciation over 27.5 years. You get to slowly depreciate that building over time. When you buy something new, you can depreciate it over a certain period of time. Like a refrigerator is 5 years, countertops I want to say are 10, a roof might be 15 years. So you can have this study done, and it will break the entire property into its pieces. And if some of those have a shorter lifespan, they can depreciate faster. And when you do this study, the IRS has this thing called bonus depreciation. And the first year, they will say whatever you're allowed to take is that first year depreciation. We'll give you, in 2021, it was 100% more of that, so you double it. Last year was 80%. This year it's 60%, although there's legislation, I think they just passed Congress, where they're going to go back to 100%. So anyways, it's a ton of money. If you buy, like, the first deal we bought, $1.7 million, we got a $450,000 depreciation write-off that year. And we only had to put $550,000 into the deal. So we got, 70% of the deal as depreciation write-off compared to how much we put into the deal. So if you have, other income that you need to offset, this is a great way to get tons of tax benefits and avoid paying the IRS until either we have to sell it or recapture it. Then you can do 1031s. There's a lot of options for what to do later on down the road. Okay, and people also want to know how much money does it take to get in. Our average check size is usually 100,000, but we do minimums of 50. Sometimes there's special circumstances, like if we have a relationship or whatever, we might go lower than that. But generally, it's 50,000 is the minimum to get in. And then what to expect is we won't do a deal unless we think we can at least double your investment over 5 years. So if you give us 50, by the end of 5 years, we will probably give you back 100. At least that's what we're planning to do every time. Sometimes it's more, sometimes it's less, what we're doing, but that's the game plan. And then this is the video. So this is one of our deals that we bought in November of 22. This is a 75 unit in San Antonio. It's doing pretty well. We're already hitting our target rents. So the video will kind of explain all that. So I don't know if I have to click.
If you click. Nope. All right, go back. I got it.
So give you a little light.
Welcome to Nexus Urban Living. This is a 75-unit C-Class apartment complex located in northeast San Antonio. So we originally started out by having a previous owner renovate everything about this property. It was originally built in 1964, but he went through and upgraded with granite countertops, brand new cabinets, brand new faucets and hardware, and really decked out everything to make this a, B+ A-class property as best he could. The trouble was, the last 4 years, ownership didn't manage the property well. They put no money towards maintenance, they put no money towards leasing and property management and upgrades and advertising, and so over time, the property slowly went into decline. Tenants noticed that, the rents never really went up over time, and maintenance and work orders kept stacking up and people started leaving. Once we took this property over, it had 30% vacancy. They had a hard time getting anybody even to show up to move in, and the people that were moving in kept leaving in droves or having maintenance work orders, so they never had an opportunity to really bring value to the building and the community. So I want to take you guys and show you everything that we're doing in the property and how it's not going to cost a lot of money.
So you see how there's this thing is African rate.
Welcome back. It's been 10 months and we've done a lot of work. Come take a look at what we've been up to. We bought all these signs and banners for the property. It cost about $2,000, but it was able to quadruple our organic leads coming in off the street to apply for the property, just because we're telling them, hey, we have a vacancy ready for lease. We added some xeriscaping to the property in this cool, winding, black and white crushed granite rock here, and that helps us keep the lawn maintenance down, but also adds a cool gateway to the property so that residents feel welcome. To attract new people into the property, we got this ceramic agave plant and put some cool stones in here. This is the centerpiece as people walk in to sign their lease. We upgraded these backyards for people's patios so that they could bring their pets over to the property. With pets come pet deposits and pet rent, and allows us to charge more. So it helps us grow the revenue for the property. People love grilling burgers, so we installed this grill so that we could allow residents to come in here and cook out whenever they want. But Texas summers are pretty hot, so we installed this pergola to have a little more shade so that people could relax under the sun. Actually, we put 3 pergola and grill stations in the property. Just open trees in the fields kind of look like a park, but when you add this skirting and some white stone, it actually adds some design element and really makes it pop. Plus, we installed a few of these pet waste stations so that residents know to clean up after their pet and keep the community looking great. This used to be littered with potholes, but once we come in, fix all the potholes, and restripe and finish the parking lot, it looks so much cleaner, adds a ton of value to the property. And we had to go in here and replace all the wood rot with skirting and new roofing shingles. This property comes with some really nice trees. This one's actually 30 feet tall. We cleaned up the clothing care facility so that residents could do their laundry, and it'd be another source of revenue for the property. We upgraded the laundry facilities with these new credit card readers. They even take Apple Pay. So, just like kitchen and bathrooms are the centerpiece of the home, a pool is the centerpiece of the outdoor common areas. You want to make this look as nice as possible, get some great photos. That's going to drive residents to want to apply and have a fun summer in the heat of Texas. Getting rid of old and broken furniture and replacing it with this new pool furniture makes you feel like you're staying in a hotel, and it's so much better. Since we've taken over, we've put $400,000 of construction and renovations into this property, and we've increased the revenue from $53,000 a month, and it will go all the way up to $88,000 a month. On a 6% cap rate valuation, that means the value went from $6.85 million where we bought it, all the way up to $10 million, just from our improvements.
As far as residents, some of them have been receptive. They want to renew. They know that the rent is probably going to go up, and they have expressed to me that they don't mind as long as their work orders are completed. As long as what they need can be fixed, there's someone here to pay attention. They have expressed a willingness to stay if we take care of them.
So we're pretty conservative when we do our underwriting. We had expected to spend $660,000 of construction upgrades on this property. However, so far, we only needed to spend $400,000 in order to start getting market rents where they need to be. So we've got another $200,000 of reserves that we can spend on upgrades, but if we don't need to and we're already hitting our business plan, we're just gonna return that to investors as early profit or early distributions. So it's a win-win. Because of the renovations and the stage photos that we had, we posted on Google and we drive engagement. We had 300 impressions a month, go all the way up to 600 impressions a month with Google, which helped drive organic traffic our way. We've taken this a Google star rating from 1.8 all the way to 3.8, and a huge improvement. When everybody is looking for a place to live, Google ratings is one of the first things they check to see if they even want to go to the next step. Location matters. We bought this property right off of I-35, which is the busiest highway in Texas going from Mexico all the way to Oklahoma. As residents drive by, if they need a place to live, they see our signage and they come in and apply. It helps us attract new residents with easy marketing. So management and operations teams makes a big difference. The previous owner had units that looked just as good as this. We didn't even upgrade this unit, but they were still 30% vacant. It takes us taking good photos, good management, and good advertising for us to attract the residents and then moving them in here. He was only able to get about $750 a month for rent, and we're able to get $1,250 for the exact same unit, just because we advertise it better and have better customer service. If you guys want to be a part of our next project like this, invest with Top Producer Investment Capital.
It's nothing like crazy. Just doing basics very well, having good customer service, paying attention to details, and sifting through 100 bad deals before you find the one good one that we bought at the right price. So
who's like managing the properties? Because you said the previous owner did all of that, right? Like they did the renovations and stuff, and the way they failed was they weren't managing the property.
So I should have put this on the story of how we bought that. Okay, so this guy, Devin Elder, he owns a lot of multifamily in San Antonio. He was the one that bought this in 2016, and he did all these renovations to make it look really nice. And then he sold it to the guy in New York, Nathan, back in, 2018. And then Nathan owned it for 3 years, a fully upgraded property, and just ran it and grabbed it, doing maintenance, had a management company in Austin and instead of San Antonio, and just kind of slid into the line. So it wasn't the guy that did all the improvements, did things right, it was the next guy.
But do you guys have do you have property management people?
We do, yes.
Okay.
So some we have in-house, some like I have a leasing and maintenance person just direct under me that I call and I set the systems up. For this one and two of our others, we use Metric Property Management. So Leslie Haynes is the owner of that company, and she's a general partner on this deal as well. And if your general partner owns the management company, she'll take a first look at making sure that this one's running very well. But yeah, we have weekly calls with them to look at the KPIs and see where rents are. At least when we were doing renovations, I was over the property once a week, making sure things were going how they're supposed to. Whenever they run reports or advertising, we give our feedback, but they have staff, I think 4 or 5 people dedicated to different aspects of this property. And they have lots of other properties in San Antonio too, so they know.
Do we have any other questions for Ryan?
At what point are you asking for investors to come in your timeline of securing the property?
So when we go under contract, we usually have a 60-day close with a 30-day option for extension. It usually takes us 2 weeks to do our first set of due diligence, take much photos, put our pitch deck together. And so I'll send out an email to the database saying, hey, we have a deal coming. I don't have the details yet, but get ready. And then 2 weeks later, we'll say, here are all the details. In written form, we're doing a webinar 2 weeks after that. So 4 weeks from when we first went under contract. And then we usually have 4 to 6 weeks to raise all of that money before we close. And that's the money we use as our down payment.
So something that somebody doing it to 31 really.
Yeah,
Might be tight.
it is tight for sure. And even if they had already sold it, 1031s allow you to take a real property and go into another real property. Technically, when you do a syndication, you are investing in an LLC, which is a company. And so with a 1031, you have to do something called a tenant in common, where you own like 8% or 20% of the building yourself, and syndication owns the rest. So that's complexity. It's not impossible, but it's usually not worth it unless you have like $1 million, $2 million. We bought this for 6.8, 85 million, and it should be worth 10 million. Yeah.
Do you think you'll see this one through the 5 years? Or is it just that?
Yeah, this one, our interest rate doesn't have a balloon payment for 6 more years, so we'll just wait until our interest rates probably get down to 5 or less. You know, well, we'll kind of see, but yeah, if we hit a valuation between 10 and 12 within the 5, we'll sell it.
How many units is it?
75.
75. How big is the property?
I think it's on 5 acres.
Did your financing, your acquisition financing, was it interest only initially, then it converts to a mini perm?
So, yeah, a lot of them are different. We bought this one as a loan assumption. So the previous owner had a loan on it, which helped as well. Rates at the time were like 6.5, but we assumed their loan at 5.1 as the interest rate. They had it with a 30-year amortization, and they were 3 years in, so it's amortizing. We're paying principal right now. They had interest only for the first 2 years that they went through.
Mm-hmm. So you come in with a little more equity you might have, but you have a low rate.
Yeah, I mean, I think we put like 27% down with the loan assumption because we decided to deal on price.
Right.
Any other questions? Thank you, Ryan.
Cool. Thanks.
Thank you. Thank you. So next up, we have Court. With Court shall fund with Nexus Private Capital. Here you go.
Thank you.
Court is a seasoned executive in multi-state real estate acquisitions, asset management, leasing, development, and commercial debt transactions. He has managed and directed a diverse range of real estate projects and affiliate operating companies. Some of Court accomplishments, but not all, include over 25 years of real estate acquisitions and development experience. He developed 2 sizable and successful business parks in Tucson and Phoenix. And he has even been the preferred development for McDonald's in Southern Arizona.
Who's hungry? I love it.
Give it up for Court.
Okay, in a second, I'll kind of give you, Debbie helped you out with some of the background. I'll touch on a little bit more, and the reason for that, not because I need to hear myself or, where I've been and what I've done in real estate. But it's 54 years in real estate, and it's touched pretty much everything you've done or will do in the rest of your careers. So with that being said, I'm gonna go around the room real quick in a word or two. Tell me what you want to get out of the next couple of 15 minutes or so, and I'll try to craft my comments with your thoughts in mind. Bearing in mind, I'm supposed to talk about creative financing. Okay, so right here, my Mr. Seat Stealer, go for it.
Was it your seat?
It was, doesn't matter.
I want to learn something new.
Something new, yes.
Well, same thing.
Something new.
Yeah, something new, something creative, and something to bring to my clients.
All right, so one of my sayings, this is what happened to me at 60, you give sayings, right, worthless sayings, is that when we do a presentation, You gotta deliver one of two things. Either it's gotta be leading edge, in other words, you heard it here first, or it's gotta be actionable. When you leave, you're saying, man, I'm glad I came because it's something I can actually put to work in my world. Okay, next up.
I don't know what you think are the hot topics.
What I think of,
What you think are the hot topics.
what I think of the
right
hot
now.
topics, okay? Okay,
How to invest without my own money.
how to invest without your own money? Same, creative finance, okay?
I want to hear how you can explain creative financing to somebody in layman's terms.
I'll do my best. I've been known to be a digit head, but I also talk too much. So you guys have a license to cut me off anytime you want. I'll try.
Yeah, similar to, Dina, like, how do you invest when you don't have millions, right? So like, how do you invest when you have like, 20 to 70K?
Okay? How much did you start with?
Start on my first deal.
Yeah.
My first duplex was like 8,000, but then on these, we raised money, so.
You started with 8,000.
On the first
Sounds
time.
like the beginning of a marketing story. That's good.
Yeah.
Right? So it can be done. Brandon.
What I can expect from my son is.
What do you mean? Okay, disclaimer. Brandon and I are cohorts, right?
That's awesome.
Next,
Again, something creative, the creative finance side.
creative financing.
Same thing.
Okay?
Same, I wish I had something
We're
else.
running out of originality.
Leveraging small dollars.
Leveraging small dollars. Debbie?
We're just here so I don't get fined.
What's that? How you don't get fined?
I'm kidding. Football. Creative financing.
Yeah, I think like we say creative financing, like to define it a little more clearly on my side is like hard money lending, and like it's more expensive, and I think we all have it in the real estate industry, like this certain perception, right, of like higher interest rate, so like it's just like this negative association with it,
Yep.
instead of thinking of it as a tool to get something done.
Okay. So we're gonna demystify hard money.
Yeah.
In order to get you where you want to go. Okay, you gave me an easy layup. I said I was gonna mention a little bit more about my background. I started Tarring Foundations at age 6. Today I manage about 110 million of investor capital, and we use it to make private loans. So we finance a lot of residential fix and flippers, small builders and developers all through Central Texas. Brandon does underwriting, I do underwriting. We have other teams, small teams, 7 of us that execute from A to Z, everything. Our record, quick show of hands, our record from initial contact with client to actually fully underwritten, fully funded and documented. Who thinks we did it in 5 days or less? Raise your hands. Oh, I'm sorry, 5 days or more, raise your hands. 3 days or more. You guys think we can do everything in 3 days? How about, nobody's raising their hands, 2 days? 2 days.
I thought it was only gonna go up from 5, but then it went down from 5,
I
so.
know, 2 days, okay. 1 day? 1 day. How about 3 hours and 15 minutes? That's from a text message from an agent at New Western. And he sent me a text message, still my phone right there, says, Court, we need you to save the day. And their lender had bailed on their client hours before the closing. And everybody's hopes that the closing doesn't go through. So when you manage a fund like we do, and you're a decision maker like I am, and we're not tied to institutional capital, credit lines or anything else,
Well, ignore that.
I don't know, hopefully you can fix that. We can make decisions really quickly. That doesn't mean we're sloppy. So that deal, full personal interview, property tour, internal analysis, credit check, background check, bank statements, tax returns, A to Z, okay, 7 Cs and more, fully funded, documented, money sent to escrow and released and funded 2 hours and 15 minutes. So hard money has a role in real estate.
Can I ask how to do that?
I don't remember, that was probably a couple 100,000, but I did the same thing a little bit longer, less than a day, $1.8 million, and I got it until Terrytown. So it's not even unusual, okay? So hard money definitely plays a role. We're gonna get into that quickly when I talk about capital stack and financing. Bunch of syndications, so when we talk about creative financing, there's two buckets of money, there's debt and there's equity, and you can slice that down into deeper tranches. I'm gonna touch on that really quickly. I've been a developer for a lot of years. I'm trying not to be. I'm doing a really lousy job in the down market because we've been taking back property and all of a sudden I'm a developer again. But small stuff, big stuff, very large scale. And yes, I was preferred developer for McDonald's USA for a while. That was a trick. That actually led to a lot about how our business model worked, our fund. Because if I develop a McDonald's site, which basically means McDonald's is all the work, I just control the land, do a ground lease, They spend $2 million to open a store. The day they open is the day I stick an advertisement in the Wall Street Journal, it cost me $450. It was microscopic, 2 lines. And guess what? I would get 15 to 30 phone calls within a couple of days. Half of them easily are cash buyers. 4.25 cap rate, Tucson, Arizona, so tertiary market. Plenty of buyers, 4.25 cap. What was going on? These are high net worth individuals with a bunch of money sitting there in cash, earning less than 1% in a bank account, but they wanted safety, safety, safety. And McDonald's is the best credit in the business, and it's a corner. And when the lease ends, they end up with a really good corner and a tangible asset. And meanwhile, it's a pure triple net lease, which means as the owner of that lease, you don't have to worry about any expenses. So what I learned from being a McDonald's preferred developer was that there's a whole bunch of people out there that want a coupon clipper that's safe. And so we designed our fund to be a coupon clipper that's safe. Different discussion, I'm happy to get into it, we can't do it in 15 minutes, but it's totally legit. And it's funny how experiences in life weigh in on business plans and strategies, right? What else is on here? So, you know, a lot of acquisitions in office, retail, industrial property all across the country over a long number of years in DC as well. So that kind of qualifies me to wrap a little bit tonight. My agenda is talk about the capital stack, which is debt and equity and tranches of it, deal structure. Ryan did a good job giving an example of a deal. I'm going to get in a little bit more nuts and bolts, actually how to structure a deal and give you some confidence. Hey, if you want to talk the language and really tee one up, how would you do it? You're going to leave here tonight knowing how to do it. You'll know how to be dangerous. And if you really want to know how to do it, you just give us a call. We're always happy to share. Okay, no problem. Come in, we'll coach you up, have at it. Good luck. We'll help you. Lessons learned, tips and tricks. Okay. All right, let's talk about the capital stack. Zane said he wants to know how does hard money fit into this, and I'm going to weave that into here before we're done. But when we say, anybody heard the term capital stack? A couple. You'll find this in sophisticated commercial transactions, typically, or institutional deals. And it's kind of funny. Most of everything that I do these days is, don't bear with me. It's pretty rinky-dink. It's $200,000, $300,000, $400,000 loans, single-family residential. The underwriting is as complicated as pulling comps and being diligent about some pretty fundamental things. It's not complicated. Now, if you go off in the middle of Timbuktu, or you're looking at a property that's got some hair on it, or it's funky in some way, there aren't good comps. Maybe you got to settle on the other valuation methods. Anybody know what the 3 methods of valuation are? Every one of you does if you're a real estate agent. I know you do. I'm putting you on the spot. It's comps, replacement cost, or income approach. Brian's using the income approach all the time because it's a rental property. It's an income asset, right? Shopping center, industrial properties, any kind of thing that generates rent of any kind. But in any event, you'll find capital stack in more sophisticated transactions, not so much the rinky-dink stuff we do today. But senior debt is here at the bottom. It's the safest trunk. It's the cheapest capital. Mezzanine equity is typically above that, and it's more expensive. It's riskier capital. Preferred equity and common equity at the top. Most people don't really talk about preferred equity, especially in our sort of rinky-dink world here. The lesser sophisticated, not big transactions. They just think about equity, and they don't even use the term equity. Because how much cash do I have in the deal? You know. So these little, I tried to kind of give you an idea of the cost. And there's so many variables that go into this, but if you go get a commercial loan from a traditional bank, you're probably 6 to 7.5% today. I'm not talking about a residential mortgage. I'm talking about an investment deal. You're buying something to make improvements to it, or you're buying a piece of land to improve it, or you're just bought an investment property that's already improved, but you want it for cash flow. You're probably in that kind of a range. Okay, 6.5, 7.5, maybe 8%. If you're doing larger transactions, they can qualify for certain buckets of money. Those numbers will come down. They'll be tied to a totally different set of metrics, and they'll tend to be a little bit cheaper by 100 basis points or so. Who knows what 100 bips is? 1%. Okay, so that's 600 basis points and 1,200 basis points typically in your senior debt. Hard money guys are more expensive. I've got a matrix on that in a second. Mezzanines can be more expensive. It's in second position. The senior piece is in first position. Less risk, less cost. Mezzanine, preferred equity, I don't want to talk about it because it's not usually in any kind of transaction you guys are doing. Common equity is the most expensive, 14 to 30%. Wide range, I'm sorry, that's because deals have such a big variation. The quality of the cash flows is what determines in an investor's mind how much risk they're willing to take. So if it's a really slam dunk deal like McDonald's USA, it's a 4 1/4, 4 cap. That kind of telegraphs how low the risk is. But if you go to a CVS, it's probably, I'm out of date, it's been a lot of years, but CVS is probably about an 8 cap, today. Walgreens is probably 8.5 cap. Walgreens is not a good credit to CVS. You kind of get the idea. That range can vary a lot all across all kinds of segments, by property type and this and that. This is too much fine print. Anybody who wants my slides, I'll send it to you. But the big story here is that, HELOC for smaller loan sizes is, for any of you and your clients, almost positively is the best source of capital. It's a line of credit on a house you currently have. It's going to be the cheapest. It's a pain in the ass to put in place. They made it difficult to get them. But once it's in place, it's a credit line. You can draw it and pay it back, draw it, pay it back, draw it, pay it back. And you can deduct the interest, okay, which is great for your taxes. So because it's got so much flexibility as a revolver, it's really handy. And it's low cost compared to all of your other choices comparatively, okay? So a HELOC, if you can do it, is fantastic. Problem is HELOCs are relatively small, okay? You might have 50 or 60 or my wife's case, she actually has several $100,000, and she has no primary debt, okay? And she uses that to do real estate investments, by the way, and it's a great source of capital, her own personal line of credit. Okay, conventional banks will be the next cheapest, but they're really complicated. They'll take more time, they're less certain. Over here on the far side, I pointed out 2 big issues. One is the loan committee, and the other is, in our case, we finance a lot of residential fix and flip or any kind of, improvements. Your conventional lenders, and Ryan, you can attest to this, and I know Zane can, your regular conventional residential commercial mortgage broker cannot finance a house that requires a substantial amount of work. They can't check the box and sell the loan into the system. So they're out, okay, for any kind of improvement property. So because they can't fund houses requiring work, they're not a good choice for a lot of kinds of loans that we do. Loan committee is also the next thing. You get a loan commitment from a bank, it's worth next to nothing. You get a loan commitment from a bank, it's worth next to nothing. There's 1,001 reasons they can get out of it, and the person that gave you that piece of paper is not the decision maker. So prepare to be retraded. And I know all of you have had clients or have your own experiences where you thought it was X and it turned out to be X minus something a day or 3 or a week before, where you thought it was closing on Thursday and that turned into the next Thursday, which turned into the next Thursday. That's what I'm talking about with your conventional banks. It's complicated and it's paperwork intensive, but less expensive than hard money. Hard money is more expensive, typically 10 to 14% today, higher points than a conventional lender and certainly your home equity line, but generally lower fees and other brain damage. Doesn't have all the processing fees. In our case, you don't need to have an appraisal for most of our stuff. We do our own in-house appraisal, so you're not having that. Surveys get waived frequently, depending upon what we see. We'll go walk a property. Lots less brain damage, and the speed I already touched on. Who knew you can close a loan in a freaking day? Who knew you could have a lender walk on a deal and you can backfill that with another lender and get it done the same day? Probably none of you knew that, right? But now you do. But there's one caveat, it's really important. 90% of your hard money lenders are not licensed mortgage originators. And the significance of that is we can only do investment loans under the law. And AKA, we cannot finance a loan if the client is going to reside in the property, and it doesn't matter if it's full-time or a second house. No bueno. Okay. There are some workarounds around that are legal, but they're expensive. They're not in the client's best interest unless it's absolutely, there's a compelling reason. Topic for a different day. Okay, so hard money loans are great for any value add opportunity. Short term, much less brain damage, moves quickly, it's more expensive than other sources of debt. I would argue more reliable, okay? but not for long term. Friends and family, private parties are pretty close. Just watch out with friends and family. Money ruins relationships. And what I have found just looking at our client base and just, over the years, most of our client base are really not sophisticated. They don't paper their deals well, and bad things happen as a result. You got to set expectations right. We're going to touch on that. All right, bottom line, HELOC's great. Hard money, cheaper than equity, and faster than conventional debt. But it must be an investment deal. Okay. Junior debt. Okay, that's that mezzanine piece. A lot of different semantics here, so I'll flush them out quickly. On the bigger deals, it's called mezzanine financing, or just mezz. On the smaller deals, you probably know it as gap financing or a second deed of trust. It all means the same thing. It's not a primary mortgage, it's a secondary mortgage. It's in a subordinate position, therefore it's riskier and it has a higher cost of capital typically. Okay, now tidbit here, distinction, it's hard to kind of touch the whole range of real estate asset classes in 15 minutes. And so one distinction, big versus small. On the bigger deals, a lot more sophisticated stuff, like a lot of my career is $5 to $20 million acquisitions, blah, blah, blah. And in that stuff, these junior debt pieces, they're heavily documented. The stack of documents is a beast. The money is coming typically from institutions, okay? They own you and your firstborn. They have enormous clause, and it is a pain in the ass. So my recommendation is when you get to that stage, it's a last resort to use mezzanine financing from those guys. It's great terms-wise in some ways until things go bad, then they own you, okay? So it's pretty tough. If your primary mortgage is 60, 65, maybe 70% of cost, the mezz guys go all the way up to about 92%, which means that you need to come in with 8% plus or minus 8 to 10%. Okay, so that's good to know. On the smaller deals in our world today, it's my world today, the gap financing world, it's two guys with a pickup truck or a husband and wife that got tired of Dell and now flipping houses. They get their primary financing from us, 70% of ARV, 85% of cost, and they go out to friends and family or somebody to get gap financing. I tell you, those deals are all over the place. They'll give just 10%, or the 10% plus 50% of the profits, or it's all over the freaking place. There is no rhyme or reason, and always it's poorly documented, which means it's an invitation for litigation. And when things go bad, that's when the problems start happening. So that gap financing in this world that I'm dealing with today is really problematic because we're dealing with unsophisticated people that don't really have it dialed in, okay? So there's a range of structures and leverage can go all the way up to 100% cost. All right, I'm shifting away from debt. So I'm moving really fast. I'm keeping up so far. Not killing it. Okay, equity. First of all, I got to tell you, you got to get the calc dialed in. I'm going to put Ryan on the spot because he told us he bought the property for $6.85 million. Is that right? Yep. And you had a loan that was 52% and equity in the rest. But what we need to know when we're doing the equity side is not just purchase price minus the debt equals equity. It's all the other stuff that goes into it. So we're not going to go through all of it, but you got a purchase price, closing costs, organizational costs. This asterisk is going to tie to my tips and tricks and little lessons learned in a second. Improvement costs. Don't forget your carrying costs. Who hates taxes? I'm so tired of seeing our clients get run because their taxes are insane, and they truly are. It's just out of control. And then working capital and contingency and other asterisks. Property costs you raised 580. When I say raise, I'm not talking about equity. I'm talking about the total capital stack. Total capital requirement is 580. Your capital stack is some conventional, some mezz, and some equity in this example. Your capital stack has 3 components. 2 debt, 1 equity. That's your capital stack. Okay? And they all have different pricing conventions to them. So if this one's 8% and this one's 12% and this one's 20%, we can actually calculate weighted average cost of capital. Discussion for another day, but the people in this business want to know that number. It's a very important number, and you manage to it. Okay. All right. So let me see. So the key here, there's a bunch of them, is when I say get the right calculation dialed in, I knew what my hard money loan or my financing was gonna be. It's probably a 70% of cost type number. And I said, okay, I wanna have 10% total equity in the deal, and I'm solving, in this case, what my mezz loan was. It could be some other combination. I can't get a mezz at all, in which case my equity needs to be 234,000, that's, or 134,000, 234, okay, some range in there. But the point is, you're gonna figure out what your total equity raise is after considering everything, not just purchase price. So get your equity calc dialed in, because the last thing you wanna do is go back to your partners after the fact and do what's called an overcall. Who's heard that term before? Overcall. You're getting something new tonight, okay? An overcall used to be really popular in the 90s, not to date myself or anything. If I go out and do an equity offering with $1 million equity raise, low, okay? It'll say, I'm gonna raise $1 million from everybody, then we'll have a 20% overcall. It's very typical. What that says is if we have unforeseen issues happen in the future, minor investor, I can come back to you and have you pony up your share of 20% of the $1 million. And it leads to all kinds of problems, because people invest their share of the $1 million today, knowing what their world looks like. But a year from now or 2 years from now, their world's changed. They may not have their 20%, their share of 20% overall. So it leads to all kinds of problems. It's getting into cram downs. You can imagine where I'm going. Don't have time for it today. All right. Point is, when you're thinking about a deal, it's not okay to think about just purchase price minus debt. You got to think about purchase price and everything minus the debt to figure out your equity raise. Okay. Quick terminology, we'll move on to tips and tricks after that. Sponsor. Sponsor is the person who put the deal together. They are entitled typically. What I'm going to do here is you're going to, in 3 slides, you're going to have an understanding of a typical way, bulletproof, to raise capital. If you went to an investor and they said, what's the structure of your deal? I'm about to give that to you. Okay. And you can trust that it's 100% on. Okay, I don't know anybody that gives us stuff away you're about to get. This concept of carried interest is really, really important, and want to make sure you have it before we go. The sponsor, the person went out, found the dirt, found the deal, figured out the business strategy, why it makes sense. For $600,000, we can do a value add. I think I can move the value to 10. If I raise, $2 million and we add 3.2, that sounded good metrics to me. I'm going to take a risk, put my money up, 10,000, 50,000, non-refundable to go tie the property up while I work it, do my due diligence. I'm spending money on due diligence. Nobody's covering my bills. If I'm wrong, I'm out my R&D, my due diligence money, right? But if I'm right and the deal comes together, great. Now I go to my investors after doing my due diligence, say I'm going to raise $2 million. The projected returns are 1.7x over a 3 or 5 or 7 year period. Okay, and I'm only looking for this much money, and here's the splits, and here's the program. Okay, this is where we're going. And if the deal works out, if you get your money back, I'm going to get a piece of the profits just putting the deal together. That's called carried interest. Okay, all right. Members, we're limited partners. They're typically passive, right? Hint, really big hint. They invest in you. You can talk to them till you're blue in the face about your deal. At the end of the day, they invest in you. Okay. When I first launched our company, Nexus, it was a $20 million fund with 4 tranches, $5 million each. The first $5 million tranche was oversubscribed in 16 days, 6.3 million in 16 days. We had 0 track record. And by the way, when you put together a fund, that's the last thing people want to invest in. You know why? It's blind. You go to Ryan, Ryan says, here's the property, here's the address, here's the pictures, here's the budget. When you go into a blind fund, you're saying, we think we can do loans with this kind of parameters in these markets with these conditions. Oh, God bless. Let me give you my $1 million, right? It's a blind fund. Nobody wants to do that. So I can't tell you how many people said, you know why we're doing this? Because of you. It's you. Okay, and that's going to come into my last point today. Okay, private placement. A little bit in the weeds here, really important stuff. Most people I interact with out in the world, in our little rinky-dink world, they have no clue what a private placement is. It's extremely important, but I gotta tell you, it is relevant for a certain scale and not below, okay? Private placement or PPM, we're offering circular. It's an unregistered document, okay, it's thick. It's an unregistered security under certain sections of the Securities Act of 1933. Right? Since 1933, if you want to issue a security, it must be approved by the SEC unless it meets an exception. Okay, there are several exceptions. I've listed the two most popular exceptions here, 506B, 506C. C came in 2014 or 15. Before that, it was pretty much all Bs. That's all anybody did. All that really means is I can do an unregistered securities offering so long as it's basically friends and family, not more than this many people, and everybody's accredited. They're sophisticated investors, which means they either have a net worth of $1 million or more, excluding their value in their primary residence, or they have an income of $200,000 a year, and for each of the last 2 years, a reasonable expectation that going forward, or $300,000 if they're married. Okay. Back in the 506B world, you were limited in certain ways. You could not advertise that security in any publication whatsoever. And you were limited who you need to talk to about it. Okay, generally speaking. And finally, most importantly, other than the advertising, is your investors self-certified, which means if Ryan wants to invest in our fund, I say, Ryan, you accredited? He says, yes, I'm done. That's great. He's self-certified. With a C, 2016, I can advertise our fund in any publication anywhere. A lot of the handcuffs are off in terms of number of investors and so forth and who I can talk to. But the burden's on me as the fund manager to certify that my investors are accredited. And it's legit. And so I have to get into their personal finances and ask them for certain proof or a letter from their attorney, either this or that. Really important stuff. If you get to the stage where you're thinking about doing a security offering, call me or call an attorney. I'll give you the Reader's Digest version. Hopefully you got to go talk to the right attorneys about this. But there's really important distinctions between these. Okay, so a private placement is a security. It's got disclosures. Okay, hey, you're going to invest in this deal. It could go south. We may not be able to get our financing. You know, there's no guarantee our rental rates are going to go up. We think this, we think that, but there's no guarantee at the end of the day. Disclose, disclose, disclose. And this document, who owns mutual funds, right? Probably most of you guys have and gals have mutual fund. You get that prospectus, there's a whole bunch of disclosures in there. But if you've ever invested in a friend's private placement, they probably didn't have the PPM, they had an operating agreement. They didn't have the disclosures. So you're investing in something that you think makes sense, but you really don't have a freaking clue because it's not been properly paid. Okay, I'm a big advocate for having a business plan. And a business plan, before I ever launched Nexus, I had sat for months and developed a 70-some page business plan with big financial models behind it. And I put it out there for some people, and guess who reads it? Nobody. But guess what? That business plan, the reason I'm such a big advocate for it, it forces you, when you write it, to think about all the things you should have prudently thought about before you embarked on the investment. By the way, if you pay to have a private placement put together, which protects you, by the way, big time, you can't really do this document unless you've thought about all the things that come out in the course of writing a business plan. Okay, so tips, guys. 3 documents in an offering. There's a formation document, which is simply a filing with the Secretary of State. I'm going to create a company, Nexus Private Capital, or whatever. It's going to be registered in the state of Texas. Here's my fees. God bless. An operating agreement, second document, really important document. I'm talking about LLCs. I'm not getting into partnerships or C corps or any of that stuff. But most people do LLCs these days. But an operating agreement is really important. The long and the short of that document is who's the manager, who are the members, how much do they put in respectively, what are the rights and responsibilities of both parties. So it tells the manager what they can and can't do. I can set up bank accounts, I can transact this kind of business, I can do this, I can do that. I can't do the other things without a vote of the members. Members, okay, there's not much they can do other than the handful of things that rise to a vote of the members. But it does outline exactly, among other things, the priority of distributions. And by the way, you think of profits, But what happens in the early years when you actually, in most real estate deals, I don't know if it's truly most, probably, there's losses. And so when we talk about an allocation of profits, it's equally important to talk about the allocation of losses because they deduct, they're deductions in your personal tax return, which allows you to shelter your income from taxes on stuff that has nothing to do with the subject property. Okay, so allocations of profits and losses come out of the operating agreement. Private placement memorandum, I talked about more than anything else, disclosure document, and it's really, really important. All right, structure. There's a gazillion approaches. I'm going to distill it all down. You know, I've done all kinds of creative things, either directly or participated in some fashion. I'm just going to give you a bread and butter form. It's 100% right on. Okay. If you're going to go put together a deal, I'm going to tell you exactly how you're going to structure the deal. If you're going to take notes on anything tonight, just either ask me for the slides or take notes on how to structure the deal. Because I haven't met anybody in my business that has a freaking clue how to structure a deal. And the only reason I do, you know, and who cares if I do, but is because I used to be an acquisitions guy. It was my job to go find deals to do, write a business plan, figure out the cash flow models, incorporate it in the business plan, and then tee it up for our CEO to approve or disapprove. And then we raise the money based upon what's in the plan and the cash flow models. And the structure of the deal I'm about to tell you shows up in the offering. Okay. So first of all, it's really important that the sponsor has skin in the deal. A minute ago, I showed you a deal where we bought the property for $400,000, we put $80,000 into it. There's $100,000 of other stuff, from working capital to transaction costs, carrying costs, and garbage, right? Okay. So, and we got down to $58,000 of equity. Don't expect to remember that, but that was the number. 58,000 of equity was the slide 3 slides ago. Of the 58,000, the sponsor should have some portion of that money in the deal. They should have skin in the game. The old rule of thumb was, and it'll come up on my last slide, it doesn't have to be a lot, but it has to be painful to the sponsor if they lose it. So when you talk about, one of you talked about how to make money on a little bit of money, and Ryan mentioned he started with 8, kind of cut him off. Okay, if he had 8,000, he put it all in. If he lost it, it was painful to lose it, right? If you're starting out with not a lot of money, you don't have to have a lot. It just has to be painful if you lose it. That's the test. And so when you talk to an investor, it's totally fine. Here's my plan. Here's a strategy. You have all the reasons why it makes sense because you've done your homework because you did a business plan. And you say, look, I'm raising $58,000. I can only put 8,000 into this, but believe me, it freaking sucks if I lose it. So you can bet I'm highly motivated to make sure this is a good deal. Okay? And an investor wants to know you've got that going. All right. Lots of structures just do an 8% preferred return. Accumulating, not necessarily paid out. Okay. It can be paid out when there's money available to pay it out. So on day one, when Ryan buys that shopping set, that multifamily deal, he spends 12 months, you know, reworking units, moving people out, moving people in. Probably isn't cash flowing, or if it is, it's not a lot, and you're keeping the cash in the house, you're not distributing it. So that 8% per year accrues, didn't get paid out. When there's money available, that's going to be the first money that's returned, before return of capital. Okay. Some people talked in the old days about compounding it. Do not compound this number. A lot of people say, investors say, well, I want a 10 or a 12 pref. They don't usually, the 10 is not out of the question. They tell you they want a 12 pref. Say, look, it's not in your best interest. I'm going to give you the best answer. This is 100% a dude in business for 54 freaking years. Here is the best answer. If an investor says, I want a 12% pref, the best answer is it's not in your best interest. The reason it's not in their best interest is you never want the manager to be out of the money. When the manager gets out of the money because they can never overcome the accumulated pref, okay, they never have a chance of making money. Someday they wake up and say, what the hell am I working so hard for? And they walk from the deal. And when they walk from the deal, the investor gets 100% of nothing. It's a real problem to step in and take over some other sponsor's deal. So your best answer is, it's not in your best interest. Okay. That is that's $1 million answer. Okay, profit split. Typically it's a 75 to 60-40 type range. There's no absolute. Really, we back in, I'm gonna explain that, what it means in a second. We back into the splits based upon your discounted cash flow model. If you run through the model and you like your assumptions and it's coming with really rich returns, internal rates of return, cash on cash for your investors, then maybe you can reduce the split to the investor. Instead of giving them 75, you're gonna give them 60. You're dialing down how much the investor gets because there is such a rich return projected for them, given the basket of assumptions going into it. You with me? Okay. On the other hand, if it's struggling to hit a number that you think the equity needs, remember equity wants to have 14 to 30, depending upon the nature of the deal. Land deals 30, 35. Prototypical bread and butter income deal 16, 18. You know. So really, you're going to arrive at that split after you've gone through a detailed discounted cash flow model. Okay, and then fees. A lot of these jokers, these sponsors, sorry, they load it up with fees. For example, they found a deal, they want to have a broker fee up front just to put the deal together, they get paid up front. And they want to go with mortgage fee, they arrange the financing, so they're going to fee the hell out of that. And then they have asset management fees and construction management fees, and they have bullshit fees of this or that. You know what the investors are going to tell you? They stop listening. Because when they see that the sponsor is in the money, when they're making too much money and the investor is taking all the risk, they say our interests are not aligned. They may not use those words, but that is a huge, huge deal. And in our fund, you know, for me, I have skin in the game big time, and our investors know that we take a hit on a loan, we take it in shorts, and they don't. We have skin in the game. We only want to make good loans. And that's very, very compelling. You got $8,000 in the deal at a 58. Hey, I know I don't have 20, 30,000, but believe me, $8,000 hurts. I'm highly motivated to make this deal work. And by the way, it's not like I'm getting a lot of money. The way I'm going to get money on this deal is a profit split at the back end, and everything works. I'm going to work my ass off to get to the back end. That's what they want to hear. I'm giving you really good advice. All right, so keep them to a minimum. Priority of distributions, AKA the waterfall. This is a vernacular commonly used in the industry. Is what's the waterfall? What does that mean? All right. In a second, you're going to see a slide. I'm going to give you an actual example of how the money works. Okay. But if you sell the asset, you bought it for 400,000, you did the stuff, you sold it for 675, you got some profits. Gross proceeds. You're going to pay off the primary debt, and then what happens? You have money available for distribution to investors. You got two kinds of investors: the manager and the members. Manager has a carried interest, right? That money is going to go first to the accumulated unpaid preferred return I told you about. Then it's going to go to return of capital, and then it's going to go to splits. So if it's a 75-25 split, whatever the profits available, 75% to the members, pro rata, based on how much they contributed of the total equity, and 25% to the sponsor as a carried interest for putting the deal together. Okay, this is what it looks like on paper. You bought it for 400, put $180,000 into it. Total cost is 580. You have 90% debt on this thing with your primary mortgage and your mezzanine financing. $58 of equity. You sold it for 675. Netted out the closing costs. It's 522 of debts paid off. You have net proceeds of 113,000. With me so far? Okay, almost done. So what happens to the 113? First to the pref, assuming a 1-year deal, 8%, $8. Next, return of capital was the $58 put in up here. That leaves 47 split 75-25. That's your prototypical structure of a deal on paper. That's a money deal right there. You can look at an investor in the eye, that holds water all day long for a lot of reasons. Okay. Tips and tricks, I'm going to have to wrap it. Be a pro, have a business plan, discounted cash flow model. My old boss used to say this in Latin all the time. Basically, good agreements make good friends. You probably got that in me applying that earlier. Have a private placement agreement for deals big enough to warrant it. JV agreements, your loan documents, if you do private party loans. Disclose, pay your taxes. By the way, if a deal doesn't pencil when it's fully loaded with everything, it's not a good deal. Move on to the next. fully loaded with everything, carrying costs, working capital, contingencies. If it doesn't pencil, move on to the next. My old boss used to say, a deal of a lifetime comes along every day, you just have to go find it. Thanks for the pressure. Okay, tight back end, what I mean by that, accounting, reporting. Nobody does this, I wish people would, but, so the tight back end, report to your investors regularly. In our case, we make monthly distributions. It's 100% every time, all the time, from profits, not from corpus or from funny money, which is cool. We produce a very detailed quarterly report, which by the way is disclosed. Nobody in our fund can never say we didn't disclose. And by the way, here's a great tip. And it's exactly that. Okay, we make monthly distributions. Most people in our business make quarterly distributions. I like to touch our investors every month. 100% of our borrowers, 100% of our investors. Imagine 110 million, 100% from word of mouth referral. We don't do any dog and bone shows. So how does our money come to us? Happy investors. They tell a friend, and up they go. Okay? So why is that? We don't leave their conscience. Every month we send them a check and a statement. Every quarter we give them a detailed quarter report. They can't forget us. That's smart. Okay? When you raise equity, raise more upfront than you think you need. It's going to drag down your internal rate of return, but give it up. You never want to go back to that investor a second time. And under promise, over deliver. We talked about having a skin in the game. And finally, after 50 years in business, I'm an overnight success. Okay, but here's the point. Huge. You build your personal brand by your actions every day. And if you want to raise money, it's your actions from yesterday and a year ago that's going to allow you to do it. Bada bee, bada bee. Questions or take them. You guys tell me if you want to do it.
Any questions for Pam?
What is the average term length that you would lend?
In our business, we do 6 or 12-month loans. Historically, they pay off in about 7 months. So there was a bunch of expectations. We came into this, learned something new. What has hard money fit in? You know, how can I take a little bit of money and turn it into something else? How do we do? We did any of those things?
The fact that you gave us a breakout of how to set up a deal was kind of wild. Like, that was amazing.
We're gonna ask you for this slide.
Yeah, you got it. So feel free to hand it out. And like I said, you know, we're super transparent at Nexus, just by generally speaking. We're always happy to help. Don't really know why we're wired that way, but we are. There's one caveat. We help people that want to help themselves and are happy to pass it on. I'm not very good at helping people who feel entitled.
Let's give it up for Cord. Last but certainly not least, we have Chris with Quest Trust. So Quest Trust is the premier self-directed IRA custodian that administers IRAs for the purpose of investing in alternative ways. It allows customers to diversify their investment portfolio and maximize their retirement saving strategies. Let's give Chris a warm welcome.
Thank you. Thanks, everyone. Excited to be here. I'll run quick through mine. Just quick raise of hand. Who knows what a self-directed IRA is or start out? Okay, so a few of you. So the term self-directed is just a fancy way of saying it allows our clients to actually utilize their retirement funds to invest in private assets. Things like real estate, promissory notes, private companies, oil and gas, etc. Right? Which is obviously quite a bit different than your traditional custodians, like your Charles Schwab, Fidelity, Vanguard, who are going to kind of lock you into the stock market. So I kind of like this slide, right? It's a guy looking at the cat in the litter box saying, never, ever think outside the box, right? We'll try to change your mind with that tonight and at least let you know there's options outside of just the stock market, right? Utilizing your IRAs. So some of the benefits, obviously diversification, right? I don't care how many stocks, bonds, you know, mutual funds you're in. If you have all your money in the stock market, you're probably not truly diversified, right? So a lot of our clients will actually have both, right? Because you can have as many IRAs as you want. You can have, you know, an IRA and a Roth, maybe at Schwab, Fidelity, work at the public sector, but then open them up over with us too, right? You can transfer that money as often as you want, because it's just going from one retirement vehicle to another. And invest in some of those things that maybe you're more passionate about, like real estate, right? You get the same tax savings, so that's the beauty, right? If you're sheltered under that tax exempt, if it's traditional, right, you're tax deferring those dollars, if it's Roth, that growth is actually growing tax-free forever. So it can be pretty powerful. Social investing, I really like this one. So think about being able to have your self-directed IRA and invest in maybe a local developer, right? Or a syndication that's doing a multifamily deal in your community, right? And you're supporting that and supporting housing for people that are going to be in your community, right? Being more in control of how you want to deploy those funds. Then invest in what you know best. Most of the people in this room, right, are interested and invested in the real estate side of things. So instead of trusting somebody else, with your money, maybe you get more control and handle that. So we have 7 different accounts that we self-direct at Quest, 3 different categories. So obviously the personal plans, your traditional Roth IRAs, your employer plans. So if you have your own business or you're self-employed, we do offer the SEP, simple, and solo. And then the specialty plans, these are kind of cool. So the HSA account we offer, and also the Coverdell Education Savings account. And what's really neat about these is you can actually partner your IRAs together on a deal. So what we'll see a lot of times is a husband and wife will each have their own IRAs, and they'll go in 50-50 or 75-25 on a deal, and you can actually pool your money together. Same with your HSAs and your education savings accounts. People will start education savings accounts for their children. The problem is there's a $2,000 max contribution every year, right? So if you start doing that math, right, it's going to take a while for you to grow those. But if you partner on maybe with your IRA, right, on some real estate deals, you can kind of grow those much quicker. So the ability to partner your accounts can be really powerful, trying to get some of those smaller accounts beefed up a little quicker. These are just some examples. So we have 3 primary departments at Quest: real estate, private entities, and promissory notes. When we talk about real estate, that's taking title, right? Or you buying a rental property, a fix and flip. Private entities, right? Multifamily, syndications, real estate. A couple others that are really popular, believe it or not, like self-storage. People are getting into the self-storage syndications. Oil and gas, right? Owning mineral rights and royalties is a really popular one right now. And obviously promissory notes. You can actually, be a hard money lender yourself with your IRA, right? Talk about that example, the social investing, lending your money to people in the community. It's a good way for you to control your returns as well. When you come up with your own note and terms, we just facilitate it, right? Quest, we don't offer any tax, legal, investment advice. That term self-directed, really, you go find your investment. We just kind of help facilitate on the back end. Think of us as the bank. But obviously a lot of different options for you to get creative with using those retirement funds. Quick little case study. This was kind of fun. Just gives you an example. This is actually a real case study of a client that we did. So they had a former employer 401k. So they rolled that, opened an IRA with us. And this goes back, this was like 2010, 2011. The purchase price, they brought a 10-unit property for $330,000, right? All cash, just bought it. And I'll tell you the icing on the cake, whenever we get done. So how it all works, kind of the magic sauce, you yourself are not the buyer on that deal, right? On the actual contract, the vesting is written up in the name of your IRA, right? So it's going to say Quest Trust Company FBO, which stands for benefit of, will be your name and whatever your IRA account number is, right? So whenever we get to that point, actually a member of Quest in our real estate department will actually work with you on going over that contract. He'll send you that contract with a read and approved boxes, right, where you would normally sign yourself. Sign those, and then actually a member of Quest will go to title and do that closing on your behalf with your IRA and do the closing. So that way the money never really leaves the IRA, right? The IRA buys it, the piece of property or whatever investment is within that IRA, then all the returns come back as well. So just like this one. So the IRA owns the property. Those rent payments of $52.35 are coming back every month right into the IRA, right? No taxes ever until you get to that point where you want to take it out and take a distribution in retirement. So completely sheltered, get 19% rate of return on your money, then all the appreciation as well, right? So the icing on the cake, I was saying, so this was back 2010, 2011. This property was bought in the Woodlands. So if you're familiar with like the Houston area, right? A nice little suburb in North Houston, bought at a really good time. Man, this is probably worth $1 million, $1.5 million, right? And when you go to sell that, it liquidates right out, and that money is, you know, cash in your retirement account. So pretty cool. Just one example. This is actually taking title, but again, we talked about a bunch of different options for you to deploy your money. To everybody, it's as easy as 3 steps, right, to open. It can sound complicated. It's really not. Step 1, obviously, open your account with Quest. It's a simple 20-minute application. I send you a DocuSign, fill out your information, copy your driver's license. It costs you $100. A couple of days later, I'll circle back with you. That step 2 is always funding, right? How are you going to fund your IRA? Do you have another IRA with one of those other custodians? Do you have an old 401k that you want to roll over? And always you can make cash contributions each year to beef up your IRA. We do charge a $350 account administrative fee each year, right? So we are a fee-based custodian. We don't take any commissions, which I think is cool. I always tell everybody, you know, you see that commercial, right? It's like our clients do better, or we do better when our clients do better. Well, our clients do better when our clients do better, right? You keep all of your money. That third step, when you actually go to make that investment, and that person from the real estate department assists you with title and that whole process, we charge a whopping $125 service fee. So really the $100 and the $125 service fee are kind of one time, right? It's open the account, you never see that again. The only thing you'll see is that $350 annual charge. We're super big on education at Quest, so we do live webinars weekly, every Tuesday and Saturday, and we'll invite people to talk about multifamily, right? Or investing in self-storage or crypto, right? I didn't touch on that, but crypto is something that you can actually use your IRA to invest in. But just have different industry leaders. If you're interested, you get on our website, questtrustcompany.com, has a list. They're all free. We stream them on YouTube. So maybe something, you know, may trigger your interest on a possibility. This is actually my QR code. So, you know, if you're interested, you know, we do offer free 30-minute consultations, you know, if you want to talk more in depth about your personal situation or have any questions, we do that. Otherwise, you know, that's our website, phone, and, you know, so that's it.
Awesome.
Thank you.
Do you have any questions for us?
I was wondering if you talk about things you do not use your IRA to invest in.
Yeah, good question. So with us, obviously, we don't do anything on the public side, right? So no public stocks, bonds, mutual funds, no life insurance contracts, antiques and collectibles, or no, and then we personally don't do precious metals. Some custodians, no gold, silver, just as a liability, right? We don't want to have a vault with all that stuff. Some custodians do. There's a couple that have questions, but that's about it.
But I would like, can't do like your primary residence with it? Or
Right, yeah, so you want to know more of the prohibited transactions.
Right, yeah.
Right, yeah, so in the eyes of the IRS, there are certain prohibited people from benefiting from your IRA. The IRA is supposed to benefit you in retirement. So those prohibited people are yourself, your spouse, linear ascendants and descendants. And this is where the IRS is weird, right? If we didn't think they were weird enough. So linear ascendants and descendants think up and down, right? So parents, grandparents, kids, grandkids. Can't loan your money to them. If you have a rental property, none of those people can stay in the rental property, right? You have to kind of stay in your lane. It could be your cousin, your uncle, Billy, you know, anybody. It just can't be parent, grandparent, kid, or any other, or their spouses. So.
Someone who doesn't skip rent.
I'll tell you though, honestly, you know, the biggest departments where we see the most transaction is going to be syndications. You know, it's very passive. right? Whenever you're taking title, you know, and you're doing a rental property or fixer flip, you're very hands-on, right? And you being one of the disqualified people, you actually can't yourself work on a property, do repairs, right? That's your IRA elements, right? You have to be hands-off, and your IRA actually has to pay those contractors any of that work. That's what keeps it under that tax exempt umbrella. So a very popular one, our biggest department is just people doing syndications, right? Because they can invest in, you know, subscribe to a company, that company does the work, and then they just sit back and so it's just another source of income, right? You're looking at maybe something that interests you, and you might not have 50 or 100 grand sitting in your checking account, right? Sometimes your retirement accounts do have that, so it's a source of funding.
Thank you, Chris. Any other questions? Any other questions for our other speakers that you might have thought of? I think y'all did a great job at explaining everything. Let's give everybody a round of applause. That concludes our investor seminar. Thank you guys so much for spending your Thursday